Hi, my name is Muhammad Adli bin Muhammad Azmi.
Assalamualaikum, I am Nur Haiza binti Azman.
My name is Muhammad Amir Alif bin Mazlan.
My name is Azra Musa binti Syaban.
I am Muhammad Haris Syafiq bin Muhammad Zaidi.
The major purpose of financial statement analysis is to provide decision makers information about a business enterprise for use in decision making. Users of financial statement information are the decision makers concerned with evaluating the economic situation of the firm and predicting its future course. Ratios are the traditional tools used to analyze financial statements. Ratio analysis examines 5 aspects of a company's financial condition and performance, which are profitability, liquidity, debt management, asset management, and market value. So I will explain to you about profitability and liquidity. So the ultimate objective of a business is to make a profit. Without profits, a company dies. So profit margins are very important metrics. In this aspect, there are 4 ratios to be calculated, which are net profit margin, gross profit margin, return on asset, and return on equity. Profitability ratios indicate how efficiently a company generates profit and value for shareholders. Next, liquidity ratio. Profits are essential, but it takes liquidity and cash to pay the bills. Liquidity ratios measure a company's ability to pay debts, obligations, and its margin of safety through the calculation of metrics including the current ratio, quick ratio, and net working capital.
So today, I will talk about the liquidity ratio. So, what is a liquidity ratio? Liquidity refers to how easily or efficiently cash can be obtained in order to pay the bills or other short-term obligation. Business need enough liquidity on hand to cover their bills and obligations so that they can pay vendors or keep up with the payroll. Also keep their operation going day in and day out. Fundamentally, all liquidity ratio measure a firm's ability to cover the short-term obligation by dividing the current asset by current liability. The current ratio includes all the current asset, means that its liquidity ratio does not involve the non-current asset or liability. The 3 main items in this liquidity ratio is inventory, current asset, current liability, and for the first item in the liquidity ratio, which is net working capital. To calculate the net working capital, we need to minus the current asset by the current liability. For the TSH resources berhad, the current asset is 75,631,000 will be minus by their current liability, which is 501,931,000, which will get the negative amount of 426,300,000. But for the United Malacca Berhad, it will get the total current asset of 176,917,000 will be minus by their current liability 104,223,000, which will get the positive amount of 72,694,000. But for the quick ratio, for the TSH resources berhad, it will be minus by the current asset minus by the inventory and will be divided by the current liability. For the quick ratio, the current asset will be 75,631,000 will be minus by their inventory, which is 2,300,000 will be divided by their current liability, which is 501,931,000. So it will get the ratio of 0.146 times. But for the United Malacca Berhad, their current asset will be 176,917,000 minus by their minus by their inventory, which is 2 million and 2,378,000, and will be divided by their current liability, which is 104,223,000. So it will get the quick ratio of 1.6747 times. For the current ratio, for the TSH Berhad, the total current asset will be divided by the total current liability for this ratio. But for the TSH Resources Berhad, the total current asset will be 75,631,000 will be divided by their total current liability, which is 501,931,000, which will get a current ratio of 0.1507 times. But for the United Malacca Berhad, the total current asset will be 176,917,000 will be divided by their current liability, which is 104,223,000, which will get the current ratio of 1.6975 times. Thank you.
So today, I will explain to you about function about asset management ratio. So, what the function of this asset management ratio? So I will tell you guys, the function of calculating asset management ratio is to measure the efficiency of a company use of its asset to product sales. It's also to measure of how efficiently management is using the asset as its disposal to promote sale. So this ratio will help to measure the profitability of a company asset. So I will show to you calculation of this asset management ratio. You can refer to this slide. Okay, first, inventory turnover. So how to calculate inventory turnover? So to calculate inventory turnover, you need to divide sales by inventory. From above company, TSH Resources says a value 73,555 ringgit Malaysia, and its inventory amount is 2,378 ringgit Malaysia. As the result of the calculation, the inventory turnover recorded 30.9315 times, while for UMCCA Berhad, sales value 73,194 ringgit Malaysia, and its inventory amount is 2,300 ringgit Malaysia. As the result of the calculation, the inventory turnover recorded 31.8235 times. So next, we move to the day sales outstanding. So how we can calculate day sales outstanding? To calculate day sales outstanding, you need to divide receivable by sales and multiples by 365 days. TSH Resources record about a big amount of day sales outstanding compared to UMCCA Berhad. The day sales outstanding recorded by TSH is 716.5622 days, while UMCCA Berhad is at 172.7010. Moreover, non-current asset turnover. So how to calculate non-current asset turnover? Non-current asset turnover, you need to divide sales by net non-current asset. As the result of the calculation, non-current asset turnover for TSH Resources is 0.0717, while for UMCCA Berhad is 0.0310. Okay, lastly is total asset turnover. So how to calculate total asset turnover? To calculate total asset turnover, we need to divide sales by total asset. As we can see for both company, total asset turnover for TSH resources is 0.0612, while UMCCA Berhad is 0.03. That's all for asset management ratio.
To calculate equity ratio, divide total equity by total assets. TSH resources total assets are valued 2,436,499,000 ringgit Malaysia, and its equity amount is 1,014,754,000 ringgit Malaysia. As the result of the calculation, the equity ratio recorded 41.65%. As for UMCCA Berhad, total assets are valued 1,202,297,000 ringgit Malaysia, and its equity amount is 1,080,904,000 ringgit Malaysia. As the result of the calculation, the equity ratio recorded 48.74%.
One is debt ratios. Debt ratios determines the ratios of liabilities and the assets of a firm. It demonstrates how risky it would be for a provider of debt finance to extend a loan to the said firm, with a higher ratio indicating a greater risk. So, the formula used to get that ratio is total liabilities divided by total asset. For TSH Berhad, the total liabilities is RM1421745 divided by the total asset, which is RM2436499, equal to 0.5835, which is 58.35%. For UMB, the total liabilities is 183,393 divided by the total asset, which is RM1202297, equal to 0.1525, which is 15.25%. Next is debt to equity ratios. Debt to equity ratios is calculated by dividing a company's liability by its shareholder equity. Debt to equity ratio is a measure of the degree to which a company is financing its operation through debt versus wholly owned funds. For TSH Berhad, the total liabilities is RM142,745 divided by the total equity, which is 1014754, equal to 1.4 times. For UMB, the total liabilities is RM183,393 divided by the total equity, which is RM1018904, equal to 0.18 times. And the last one is time interest earn ratio. Times interest earn ratio measures the extent to which firms earning before interest and taxes can meet the expense. The TSH Berhad, the earnings before interest and tax is RM203073 divided by the interest equity, which is RM55372 million, equal to 3.7 times. For UMB, the earnings before interest and tax is RM26,200,000 divided by the interest equity, which is 5,739,000, equal to 4.6 times. So basically, the lower the ratio of times interest earned is, the more firm is burdened by the debt expenses.
To calculate net profit margin, divide net income by total revenue. As the result of the calculation, the net profit margin for TSH resources is 54.89%, while UMCCA is 47.77%. To calculate gross profit margin, subtract cost of goods sold from total revenue and dividing that number by total revenue. TSH resources recorded a big amount of gross profit margin compared to UMCCA. The gross profit margin recorded by TSH is 95.17%, while UMCCA is fall behind at 9.95%. To calculate return on asset, divide net income by total asset. As the result of the calculation, the return on asset for TSH resources is 1.65%, while UMCCA is a little bit higher at 9.2%. Calculate return on equity, divide net profit after tax by total equity. As the result of the calculation, the return on equity for TSH resources is 3.45%, a little bit lower from UMCCA, which is 3.69%.
Next, the calculation under market value ratios, which is earnings per share. Earnings per share measures the amount of net income earned per share of stock outstanding. In other words, this is the amount of money each share would receive if all of the profits were distributed to the outstanding shares at the end of the year.
Today I'm going to compare which company is better, which are TSH Resources Berhad and United Malacca Berhad. First of all, we're going to compare from a liquidity ratio. Liquidity ratio is a ratio that that measures a company's ability to pay short-term obligation. We can see United Malacca Berhad have a better ratio of net working capital, current ratio and quick ratio than TSH Resources. So United Malacca Berhad more better. Next is from a asset management ratio. Asset management ratio is actually ratios that key to analyze how effective and how efficient a business or a company use their assets to produce a sales. We can compare that inventory turnover of TSH, days sales outstanding and non-current assets turnover of TSH is better than United Malacca Berhad, but United Malacca Berhad have a better ratio of total assets turnover. Based on asset management, I can say that TSH Resources Berhad have a better performance. Next, a debt management ratio. A debt management ratio is a ratio that measures the firm's ability to repay a long-term debt. The company have a better performance is United Malacca Berhad because based on the ratio, a debt ratio, debt of equity ratio and time interest earned, they have a better performance than TSH, but TSH have a good ratios on equity ratio. Overall, on debt management, I can say United Malacca Berhad have a good ratio than TSH. Next, we're going to look at a profitability ratio. Profitability ratio is a ratio that measures and evaluate the company's ability to generate income relative to balance sheet assets, operating costs, and shareholders' equity during a specific period of time. How they generate their incomes. Who is more profitability? Okay, so I can say based on what we calculate, TSH Resources has a better ratio on net profit margin, gross profit margin, and a return on equity. They have a better ratios of profitability, and United Malacca Berhad have a return on assets, a good performance of return of assets in profitability ratio. Okay. Next, we gonna look about market value. We can see market value ratio are used to evaluate the current share price of a publicly held company stocks. we employed by current and potential investor to determine whether the company are overpriced or underpriced. We're going to look at earning per share. Based on earning per share, we can see that United Malacca Berhad have a better ratio than TSH Resources. So we can say that United Malacca Berhad is more has a good performance than TSH Resources Berhad.
Okay, so next we will be moving on to industry comparison analysis. So I will talk about the quick ratio as the first one. So basically in the industry, the best quick ratio for plantation is 0.24 times. So as we can see, TSH Resources recorded the nearest amount with the best recorded in industry, which is 0.1461 times. Next, we will see the inventory turnover. In industry, the good performance recorded were 12.03 times. And in this record, we can see that United Malacca Berhad recorded to the nearest best performance record. Okay, next, as for debt ratio, the industry recorded 70.07% as a good performance, and we can see United Malacca Berhad record to the nearest percentage as industry, which is 15.253%, and TSH Resources Berhad recorded way too high amount. And last but not least is return on asset. So industry recorded 8.29% as the best performance, but both of the company recorded way too low than the industry. But so far, the United Malacca Berhad still get a better performance than the TSH Resources.
We will see the comparison between the two companies of the general activities that generates the cash flow. Okay, so for the cash flow from the operating activities for the TSH Resources Berhad, it generates the negative amount of 22,788,000. But for the UMCCA, United Malacca Berhad, they generates 16,163,000, which is we can see that the UMCCA generates less negative amount than the TSH Resources Berhad.
After that, we're going to compare cash flow from investing of both company, which are TSH Resources Berhad and United Malacca Berhad. Okay, cash flow from investing is actually the section that tracks cash flow generated by the sales and the acquisition of long-term investment such as land, building, plant and equipment, vehicles. After all, the sales of assets will generate cash flows, while the when we land acquisition will generate inflow of assets. Okay, basically UMCCA has a best inflow than TSH because it generates more amount. UMCCA generates almost 97,342,000 ringgit, while TSH Resources generates 479,000 ringgit in a cash flow from investing. So we can say that UMCCA has a better cash flow from investing.
So next, we will see the general activities that generate cash flow. Okay, so for the cash flow of the financing activity for TSH Resources generate negative 16,373,000, while for UMCCA Sendirian Berhad generate negative 89,779,000. So we can see that TSH resources generate less amount than UMCCA Berhad.
Ratios analysis is a popular technique of financial analysis. It is used to visualize and extract information from financial statements. It focuses on ratios that reflect the profitability, efficiency, financing leverage, and other vital information about a business. One of the key factors in ratios analysis is the comparison to the benchmark companies of an industry. This type of financial analysis can be useful to both internal management and outsider analysts of the company, as it provides significant insights from the financial statements. As with any financial analysis technique, there are several limitations of ratios analysis. It is crucial to know this limitation to avoid misleading conclusions. Some of the most important limitations of ratios analysis include historical information. Information used in the analysis is based on real past results that are released by the company. Therefore, ratios analysis metrics do not necessarily represent future company performance. Next is inflationary effects. It is the financial statements are released periodically, and therefore there are many time differences between each release. If inflation has occurred in between periods, then real prices are not reflected in the financial statements. Thus, the numbers across different periods are not comparable until they are adjusted for inflation. Next is changes in accounting policies. If the company has changed its accounting policies and procedures, this may significantly affect financial reporting. In this case, the key financial metrics utilized in ratio analysis are altered, and the financial results recorded after the change are not comparable to the results recorded prior to the change. It is up to the analyst to be up to date with changes to accounting policies. Changes made are generally found in notes to the financial statement section. So the last one is operational changes. A company may significantly change its operational structure if anything from their supply chain strategy to the product that they are selling. When significant operational changes occur, the comparisons of financial metrics before and after the operational change may lead to misleading conclusions about the company's performance and their future prospects.